On today's episode of the Cryptoverse, I have a theory as to why the crypto markets have taken another step down today, and I think it may have something to do with this story about a federal judge and ICOs. Now, I don't know about you, but I'm getting really sick of my videos dealing with governments, regulations, or the law. I mean, both videos this week have been primarily about regulation, either on Monday with the SEC suspending trading of that European crypto product, or on Tuesday with the Gemini dollar being the first regulated stablecoin. I just want you to know that I did not get into the crypto media business to constantly be talking about the old financial system. It just so happens that this week there's been a slew of stories that related to regulations that I felt the need to report on. And today's happened again because the crypto markets have taken yet another step down, and it looks to me to have coincided with this news about a United States federal judge ruling ICO frauds do in fact fall under securities laws. So let's unpack this one together as we normally do, and we'll examine the pieces so we know exactly what's going on, what the implications are for our crypto investments, and ultimately what action we can take. One action everyone should definitely take, if you haven't already, is to start using today's sponsor, which is Binance. So Binance is the world's #1 crypto-to-crypto exchange by volume. They've consistently proven themselves to be proactive in their security measures and have thwarted a number of attacks, some of which were actually due to poor security from their users rather than the exchange itself. They even now set aside 10% of their trading fees to offer protection to users who lose funds in extreme circumstances. So Binance is the exchange that I personally use far more than any other. So if you sign up for an account using my referral link below, you'll not only get the best crypto trading experience around, you'll also help to keep this channel going. And just by the way, if you hate ads and sponsor spots and you want to get rid of them, you can now do so because the Cryptoverse Patreon page is live. So just go to thecryptoverse.show, click on support the show, and you'll find out more. So let's face reality here. Ethereum's price in US dollars is in a steep decline. Here is the Ethereum price. According to my technical analysis, the next support line isn't until $136. Which was the low of the 16th of July 2017. Now look at the three arrows here on the screen. The red arrow in the far left here, this is the previous low that I'm talking about at $136. That's the 16th of July 2017. This red dotted line that goes across the screen, that's the current price line, which right now is $170. And then the green arrow on the far right here, that's the current daily candle that's being formed at $170-ish. Now the crypto market went through this mania, as a whole last year, but Ethereum in particular, it benefited from being the platform of choice for ICOs. So Ethereum's smart contract functionality makes it so much easier to create a new token or a new cryptocurrency on the Ethereum network versus the huge complexity of establishing a brand new blockchain just for that token. Now this statistic came from January of 2018, but at that time, Ethereum tokens made up 91% of the total cryptocurrency market cap. And let's face it, the lowest price that Ether itself saw in 2018 in January was $770. That's the lowest it got in January of this year. So, while this wasn't the exclusive reason for Ethereum's rise in price, I am suggesting that a lot of it had to do with the fact that people saw Ethereum as providing a genuinely useful service. So that directly contributes to Ethereum's fundamentals, its fundamental value, which then sort of creates a feedback loop when people expect those fundamentals to get stronger over time, and then the price continues to rise. So that's the setup. Now let's look at today's news that may have caused a significant dip, not just to Ethereum's price, but across the entire altcoin market. So according to my research, it was Bloomberg that were the first to break this story. This was yesterday afternoon at 5 p.m. London time approximately. And the headline is, US judge says initial coin offerings covered by securities laws. But wait, in the very first line of the article body, it says, a federal judge has ruled that US securities laws may cover an initial coin offering. Well, we already knew that, didn't we? So what? We already knew that US securities laws may cover initial coin offerings, right? We already knew that this because it was the whole discussion throughout the whole of 2017. It was a discussion that ran directly alongside and parallel to the boom in ICOs themselves as the new revolutionary funding method. So I felt a little bit angry about this because I believe Bloomberg left the word may out of the headline itself. They did that on purpose, I believe, because they know it immediately softens it. I also believe that they know the vast majority of their readers don't actually read the entire article. Fortunately for me, and unfortunately for them, I am blessed with an eye for detail, so I do read the entire articles, and I do not miss such details. So let's now go one level deeper. US District Judge Raymond Deary said that the government may proceed with a case against a man charged with promoting a digital currency backed by real estate and diamonds. Now, the prosecutors say this man never had any of the real estate or the diamonds and was acting in a fraudulent manner as a result. So this is a criminal fraud case. Now, I think I mentioned this in Monday's episode. This has very little to do with cryptos or ICOs, again, not at its core anyway. This is about a man promoting a fraudulent real estate investment scheme. Right? You could report this story without mentioning the fact they did it in an ICO, and it would still make perfect logical sense in the context of being a judicial case. Now, I'm not suggesting that you should leave a detail like that out, right? Omitting the fact that he was doing an ICO, that would be weird because it's a key fact in the case, right? I'm just saying that by mixing the concept of the ICO in this news story about a man committing fraud is very likely what lead to readers, conflating the two in their mind. Again, remember, the eye for detail gives me the gift of discernment, right? This is not a skill that's well developed by the masses. So they'll tend to clump concepts together, kind of like different colors of Play-Doh being lumped together. So the question really is, what would have happened if this man did the ICO, but he did have the real estate and he did have the diamonds? And what if he owned those outright? And what if he acquired them legally and then did an ICO? Unfortunately, the only way we'll ever know that, how that would pan out, is if we actually got a real case and it was actually presided upon by an actual judge in the same position. Actually, perhaps in my example, it would never reach the courts, because it was legit. So that would actually prove my point, wouldn't it? That there's nothing illegal about ICOs themselves, only how they are conducted. And it's the conduct that is already covered by existing laws, right? If you conduct yourself in a fraudulent way, ICO or not, you're going to get pinched for it. In fact, the Bloomberg article actually says that the judge's decision focuses on the particulars of this ICO and not on other ICO transactions. However, if this guy gets convicted, it's going to have wider ramifications, right? We already know that. The judge actually said in his ruling here, quote, "Simply labeling an investment opportunity as a virtual currency or a cryptocurrency does not transform a security into a currency," close quote. So apparently this guy didn't even issue any digital tokens to the people who invested money, yet he still denies wrongdoing. So circling back to this, how this may affect the crypto markets. Now, given that Ethereum-based tokens accounted for the vast majority of the market cap at the beginning of the year, and given the large amount of that was the result of money flowing into ICOs, investors in those coins may now be in a panic selling situation. So if we follow the logic, it probably goes something like this. So this is the likely thought process in their mind. This guy gets convicted. The ICOs that I invested in get targeted next. They go out of business, the token price goes to zero, and I lose all my money. Now, this particular court case relates to an ICO that clearly appears to be fraud. I don't think anyone would argue with that, but the court case still has to go out, which is why you have to say alleged fraud until it's actually been convicted, which is why I say it clearly appears to be fraud, because I don't want to implicate myself as judging it before the actual court system has finished its job. But sadly, the fact that this one is such a clear fraud, that's not going to stop the fear from spreading even to the legitimate ICOs. Now, the ICOs don't have to get targeted by the justice system, right? The market just needs to perceive that as a high risk in order to generate the emotion of fear, and it's emotion that puts us human beings into action. And action, in today's terms, seems to be selling a bunch of altcoins out of fear. So how this ultimately circles back to Ethereum itself is that while Ethereum itself has already been cleared of being a security, that fundamental utility value that we spoke about earlier on is also now looking like it's going to be eroded. And what I think is leading to Ethereum's price fall as a result, because fewer ICOs are going to be using Ethereum because of this fear that ICOs may be deemed a security. That damages the fundamentals of Ethereum, makes it less useful, and therefore makes the Ethereum token itself less useful. This is actually precisely why I put together my Truth About ICOs in 2019 and Beyond video. Now I know the stats, I've looked at them, and I know the vast majority of you have not watched that video yet. So please, now go back and review it in the context of today's news. And it will have a new colour to it, a new richness. You should have watched it in the first place, but please go back and watch it. It's a key video. So what's a crypto investor to do, you ask? That very much depends on how close you are to your resilience threshold. It's the very fact that many investors have just been pushed over their resilience threshold by this news. They're now beyond their ability to stand the mental discomfort that's causing them to dump their coins. That's a natural reaction. It just reinforces the fact that this crypto market is so brutal, it's really only for the most resilient people, or those with faith in the long-term potential in this industry that will be able to hold out. Now, I don't mean to be glib, but these are the dynamics of a super high risk, super high reward market. So, and you know what's going to come next, because I've said this before. My recommended tool of choice for building mental resilience is meditation. So thanks very much for joining me today, guys. If you liked this episode, go ahead, hit the like button. If you disliked it, you can hit the dislike button. Please leave me a comment below with some feedback, and of course, get subscribed. And if you would like access to my very best material, such as my structured online courses, check out my website, cryptoversity.com, click on courses, and you can take any one of these online courses that I've created for your educational delight. If you want to follow me on the social networks, check out the podcast page on the website, and all the social networks that I'm on is listed right there. Other than that, I will be back with the next episode of the Cryptoverse. So until then, it's me, Chris Coney, saying bye for now.